Most people don't realize this, but if you retire with only $100,000 in savings, you could run out of money within just a few years. Think about it. If you spend only $1,900 per month, your entire savings could disappear in about 4 years. And then what happens? You're forced to go back to work, rely completely on Social Security, or worse, end up with nothing left. But what if I told you that the same $100,000 could potentially grow into 3 or even $4 million over time? In this video, I'm going to show you the three most powerful index funds that have the potential to make that happen. We'll break down the returns each fund can generate, and by the end of the video, you'll discover an index fund capable of turning a one time investment into a portfolio worth nearly $4 million, while producing around $11,000 per month in dividend income. So, how can $100,000 grow into millions? It all starts with understanding index funds. An index fund is like a giant basket filled with shares from many different companies. Instead of putting all your money into a single stock, you spread it across hundreds of companies. This helps reduce risk because if one company performs poorly, others can help balance things out. Investors love index funds for one simple reason: they're low cost, easy to manage, and have a strong long term track record. Unlike actively managed funds, where professionals constantly try to pick winning stocks while charging high fees, index funds simply follow the market. That means lower costs and more of your money staying invested and compounding over time. And the best part, they require almost no effort. You invest once and the fund does the work for you. Now let's look at three funds with the potential to turn $100,000 into life-changing wealth. Coming in at number 3 is the Vanguard S&P Small Cap 600 Index Fund, ticker symbol VIOO. This fund focuses on small cap companies in the United States. While giant companies like Apple and Microsoft get most of the attention, smaller companies often have much greater growth potential. That's what makes this fund such a powerful opportunity for long term investors seeking serious capital growth. These companies may not be household names yet, but because they're still in growth mode, they often expand faster than larger corporations. They simply have far more room to grow. That's why this fund is focused more on growth than dividends. Yes, it may not pay massive dividends right away, but for patient investors, the long term upside in share price appreciation can be extremely powerful. The fund also provides strong diversification by investing in 600 small companies across multiple industries. If some companies struggle, others can offset those losses. This gives investors broad exposure to the small cap market without putting all their money into one place. And thanks to Vanguard's low cost structure, the expense ratio is only around 0.08%. Lower costs mean more of your money stays invested and continues growing over time. One of the biggest strengths of this fund is the growth potential of small cap stocks. Historically, small companies have tended to outperform larger corporations over the long run. They can move faster, adapt more easily to market changes, and often have far more room to expand. While they may experience greater short term volatility, patient investors can benefit from powerful long term gains. But it's important to understand something. The Vanguard S&P Small Cap 600 Index Fund ETF is not a get-rich-quick investment. This strategy is about allowing your money to work for you over many years. In the beginning, the progress may feel slow, but the real power reveals itself over time through compounding. Now let's look at what happens if you invest $100,000 into this fund. Based on the fund's historical averages, it offers a 1.48% dividend yield, 11.19% dividend growth, and 7.08% annual share price appreciation. After the first year, the investment would grow to approximately $108,580. By year 10, the portfolio would reach around $234,789. After 20 years, it would grow to roughly $592,905. But the real transformation happens after 30 years. That original investment could grow into a portfolio worth approximately $1,689,748. At that point, the annual dividend income would be around $70,959, which equals roughly $5,921 per month in passive income. Out of the total gains, about $1,059,698 would come from share price appreciation, while approximately $528,065 would come from reinvested dividends. As strong as these results are, the next option is even more impressive. Coming in at number 2 is the Wisdom Tree US Value Fund, ticker symbol WTV. Unlike growth focused funds, this one focuses on value investing. Instead of chasing small, fast growing companies, it invests in strong businesses that are trading below their true value. Think of it like searching for products on sale. Value investors look for companies the market has undervalued. Some of these businesses may have faced short term challenges, but their financial foundations remain strong. That's exactly the type of opportunity the Wisdom Tree US Value Fund targets. Unlike the previous fund, this one invests in larger and more stable companies. They may grow more slowly, but in return, they offer stronger balance sheets, reliable customer bases, and greater stability. That's why value stocks tend to hold up better during market downturns. One of the biggest advantages of the Wisdom Tree US Value Fund is its lower volatility compared to aggressive growth funds. During market declines, value stocks generally lose less value than smaller growth companies. This creates a more stable experience for investors who don't want extreme swings in their portfolio. The fund also places strong emphasis on dividend growth. As a result, investors can benefit from steadily increasing income and a growing stream of cash flow over time. The Wisdom Tree US Value Fund doesn't select companies based only on market size. Instead, it focuses on strong financial fundamentals such as earnings, balance sheet strength, and dividend performance. This approach helps identify powerful companies that the market may currently be undervaluing. As the market eventually recognizes their true worth, both stock prices and dividend income can continue to grow over time. The fund also keeps costs low, with an expense ratio of only 0.13%. In addition, it offers approximately a 1.48% dividend yield, 12.68% dividend growth, and 9.76% annual share price appreciation. So, what happens if you invest $100,000 into this ETF and leave it untouched for 30 years? After the first year, the investment would grow to approximately $111,280. By year 10, the portfolio would reach around $296,289. After 20 years, it would grow to nearly $923,387. But the real transformation happens after 30 years. That original $100,000 investment could grow into a portfolio worth approximately $3,079,149. At the same time, it would generate around $93,373 per year in dividend income, roughly $7,794 per month in passive income. Out of the total gains, about $2,307,243 would come from stock price appreciation, while approximately $671,915 would come from reinvested dividends. So far, we've explored the growth potential of small cap companies and the power of value investing. Now it's time for the number one fund, the Fidelity Total Market Index Fund, ticker symbol FSKAX. This fund covers the entire US stock market. It invests in large cap, mid cap, and small cap companies all at once. Instead of focusing on a single sector or strategy, you gain exposure to the entire market. This creates both strong diversification and long term growth potential. What makes the Fidelity Total Market Index Fund especially powerful is its ability to combine growth and stability at the same time. Unlike the Vanguard S&P Small Cap 600 Index Fund, which focuses on smaller companies, or the Wisdom Tree US Value Fund, which targets value stocks. This fund gives investors broad exposure across every sector and market size. One of its biggest strengths is natural diversification. Since the portfolio contains thousands of companies, poor performance from a single stock has very little impact on the overall investment. This becomes especially valuable during volatile market conditions. While some sectors may struggle, others can remain strong, helping smooth out the returns over time. That's why this fund is ideal for a long term buy and hold strategy. The expense ratio is also extremely low at around 0.03%. Oh, on top of that, the fund has historically delivered approximately 10.54% annual share price appreciation, a 1.98% dividend yield, and 12.14% dividend growth. This combination creates both strong capital growth and steadily increasing passive income. Now let's look at the numbers. Imagine investing $100,000 into this fund. After the first year, the investment would grow to approximately $112,550. By year 10, the portfolio would reach around $329,037. After 20 years, the portfolio would grow to approximately $1,118,176. But the real payoff appears after 30 years. That original $100,000 investment could grow into an incredible portfolio worth approximately $3,976,779. At that point, the annual dividend income would be around $108,329, roughly $9,056 per month in passive income, enough to comfortably cover most people's living expenses. Out of the total gains, approximately $3,034,687 would come from stock price appreciation, while around $811,146 would come from reinvested dividends. Thanks for watching the video. If you want to see more powerful content about financial freedom, passive income, and long-term investing, don't forget to subscribe to the channel. See you in the next video.